Namaste, my friend. 5.9%. Now, you might be looking at that number and thinking it's a pretty solid monthly return, right? Well, nope. That is a massive, sudden, single-day spike in gold prices that we literally just witnessed. As a financial advisor, looking at the charts today, I really had to ask myself, what on earth caused this kind of intraday shockwave? I mean, why did precious metals suddenly skyrocket while other chunks of our portfolios were bleeding out?
Welcome to today's Explainer. I'm your host and your trusted market navigator. Listen, today we're going to decode one of the most volatile and honestly fascinating trading sessions we've seen in a good while. We're going to zoom all the way out to look at the big macroeconomic triggers, and then we'll drill right down into specific stock fundamentals and institutional money flows to figure out exactly what is happening in the Indian markets right now.
Here is our strategic roadmap for today. First, the market's choppy ride, then sector shifts and golden surges, followed by open interest, corporate earnings, and finally, tracking the smart money. Let's get right into it.
Section 1. The market's choppy ride. A V-shaped intraday roller coaster?
Okay, so the Nifty 50 opened with a nasty gap down today, basically extending the weakness we've been seeing over the last 4 sessions. Within the first 30 minutes or so, pure panic set in. We saw the index drop sharply down into that 23,260 zone. But then, boom, aggressive buying triggered. The bulls actually stepped right in, clawed back the 23,400 mark by late morning, and pushed us all the way up to 23,580 by 1 p.m. We ultimately closed flat, but extremely resilient at 23,412.60. Honestly, what a recovery. But hey, if you peek beneath the surface of that flat index, a totally different story was unfolding. We had 301 advances against just 197 declines. This means the broader market breadth actually turned positive for the first time in 3 whole sessions. Mid-caps outperformed sharply too. So for retail investors like us, this strongly suggests that the worst of this recent panic might just be hitting the pause button.
Moving on to Section 2, Sector Shifts and Golden Surges, where the action was.
Guys, we are witnessing a massive sectoral tug-of-war right now. Look at this. The IT sector bled another 1.13% today, extending this completely brutal run that's dragged the whole sector down over 10% since late April. But on the flip side, commodities and metals are absolutely surging. The Nifty Metal Index jumped 3.18%, and gold and silver skyrocketed by 5.9% and 6.59% respectively. Just incredible moves.
So what exactly triggered this massive spike in commodities? The answer is policy. The government officially hiked up the customs duty on gold and silver imports, taking it from 6% all the way up to 15%. Now, this isn't random. It's a deliberate, highly calculated move aimed at conserving our foreign exchange and protecting a macroeconomic stability, especially with the ongoing global uncertainties like the crisis in West Asia. It's a textbook example of direct policy impact perfectly reflected in today's commodity charts.
All right, Section 3, Open Interest, Charting the Course, Finding Our Technical Coordinates.
Let's put our technical strategist hats on for a second. Analyzing the open interest, or OI data, we can clearly spot maximum call open interest building up right at the 23,500 level, and right behind it, another massive wall at 23,900. Now, on the flip side of that, maximum put open interest is securely anchored down at the 23,000 level, with a nice secondary support base forming at 23,400.
So the absolutely crucial point here is how we translate all that complex data into actionable trading zones for you. Based on the heavy put writing we just looked at, your rock-solid support zone is sitting comfortably between 23,100 and 23,200. On the flip side, the aggressive call writing tells us there is stiff resistance waiting for us between 23,600 and 23,700. Make sure you get these coordinates saved in your trading journals, my friends.
Section 4. Corporate Earnings and Fundamentals. The Engine Room.
Okay, let's do a rapid-fire round of today's massive business moves, because there are a lot of them. First off, the Union Cabinet just greenlit a huge 37,500 crore incentive scheme for coal gasification. This is a massive push for cleaner domestic energy so we can reduce import dependence. Next up, Uber is officially partnering with the Adani Group to set up its very first data center here in India. And just look at Texmaco Rail. Their shares surged up to 13% today after they bagged a landmark 4,045 crore export order for freight wagons and locomotives. These are huge fundamental shifts happening at lightning speed.
Now let's check out the earnings scorecard.
It is literally a tale of two extremes. Stovecraft reported a jaw-dropping 318% jump in Q4 net profit, purely driven by soaring domestic demand for energy-efficient cooking solutions. Tata Motors' commercial vehicles also had a brilliant quarter, with profits up 70%. But it's not all green out there. Cipla took a really heavy hit. Their profits dropped 55% due to weak U.S. sales and severe pricing pressure abroad. And Bharti Airtel saw a 34% decline in net profit. The big takeaway? Strong domestic demand is clearly the winner here.
And speaking of fundamental pressures, you know that when the RBI speaks, we have to pay attention. RBI Governor Sanjay Malhotra explicitly warned about these ongoing global supply shocks. He cautioned that if this continues, it's really just a matter of time before the government will be forced to pass those price increases on to the consumer. Guys, this is a glaring warning signal for potential fuel price hikes ahead, which is going to heavily impact our inflation targeting. Finally, Section 5, Tracking the Smart Money. Institutional flows. We are watching an incredible market tug-of-war right now. For the day, foreign institutional investors, the FIIs, were still net sellers, pulling out 1,959 crores. But our domestic institutional investors, the DIIs, stepped right in and heavily bought the dip, injecting a massive 7,990 crores into the market. That leaves us with a combined net positive flow of over 6,000 crore. Domestic funds are showing immense confidence right now, practically holding the market up against all that foreign selling pressure.
Which brings us to the ultimate question for our very next trading session. We've got heavy technical resistance looming right above us at 23,600. Foreign investors are clearly still selling. But on the other hand, we have this incredible domestic institutional buying, booming domestic corporate earnings, and positive market breadth. So, I leave you with this thought. Will this domestic fundamental strength actually be enough to break through that technical ceiling? Study the data we discussed today. Keep a very close eye on those support levels, and until next time, trade smart and stay focused.